Welcome to your daily Solo 401k webinar and Q&A session with my Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic, altruist advisors. Open Solo 401k by December 31st to unlock top features like the Mega Backdoor Roth, $1,500 in Solo 401k tax credits, and more. This is your chance to get answers, so please use the chat now to ask questions on today's topic or anything else. Please chat them over now so that we can be sure to get to them all. Let's get started. So as always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. All right, wonderful. Here, let's give a quick overview of where we're headed, what you'll learn today, why setting up a solo 401k plan now matters for your clients, what you might lose if you wait until 2026, key benefits you lock in before December 31st, 2025, how to get started today with Altruist and my solo 401k Financial. As we dive in, though, let's first lay the foundation with understanding the solo 401k eligibility rules. So, a solo 401k is a self employed retirement plan for self employed individuals. There's two prongs that one needs to meet in order to be eligible. So, you first have to be self employed, number one, and then number two, not have any full time employees working for you. So, let's dig a little deeper on each prong. So, in terms of demonstrating that you're self employed, it comes down to reporting earned self employment income. So, for example, in the case of a business that's taxed as a sole proprietorship, could be a single member LLC taxed as a sole proprietorship. Earned self employment income is income that's reported on Schedule C of your 1040. For a business that's taxed as an S Corp or a C Corp, earned self-employment income is income that's reported on a W-2 that you receive from the S Corp or the C Corp. And then finally, if your business is taxed as a partnership, earned self-employment income is going to be income reported on line 14 of the K-1 that you receive from the business taxed as a partnership. Now, the other prong is that you cannot have any non-owner, non-spouse, full-time W-2 employees. So that means you could have independent contractors working for you because those individuals are not W-2 employees. You could have individuals that don't work on a full-time basis. Now that bar has been lowered over the years. So to be safe, you would want to make sure that each person works less than 500 hours per year. On the other side, you can still have your spouse working in the business and still qualify. So spouses can participate. Other owners, as long as they're at least 3% owners of the business and reporting their own earned self-employment income, can participate, and you would still be eligible for a solo 401k. So all that adds up to that a solo 401k can be ideal for those self-employed individuals who operate as consultants, as realtors, as freelancers, or other small business owners. So that's what gets you into the game. Now, reasons to set up a solo 401k are many, but we want to focus on some of the top reasons, and specifically in the context of reasons to open up a solo 401k before December 31st, as opposed to waiting until next year. So, reason number one is to lock in contributions. So, what we mean by that specifically is that if the plan is established on or before December 31st, 2025, that's going to give you the most options to make the most types of contributions and have the most time to do it by. So, in other words, if you sign up by the end of the year, that means you establish the plan by the end of the year. So, that'll preserve the ability to make all types of contributions. So, the most types, right? Employee, employer, even voluntary after-tax, which is how you make Mega Backdoor Roth contributions. It also gives you the most time because if you sign up by the end of the year, you'll be able to make contributions all the way up until your 2025 business tax return deadline, including extension in 2026. Now, for those that are self employed, the contribution deadlines are different than for those who have a 401k plan through their day job. If you have a 401k plan through your day job, you need to make the employee contributions by the end of the year. But the rules are different for self-employed individuals. You have more time, and it makes sense from a policy perspective because your ability to contribute is based off of your earned self-employment income. Many self-employed individuals don't know how much they've made until the end of the year or even sometime after. So as a self-employed individual, as long as you establish the plan by the end of the year, you can make all types of contributions, whether employee, employer, or voluntary after-tax, by your business tax return deadline, including extension in 2026. So that means you could take your time to open up accounts, take your time to determine how much you're going to contribute. But as long as you sign up by the end of the year, now you'll preserve all the options, the most options available. Reason number two are the tax credits. So the Secure Act was a landmark piece of legislation passed by Congress that included a number of tax credits to encourage small businesses to establish solo 401k plans or to establish 401k plans generally. Now, some of those tax credits are not available to solopreneurs that establish solo 401ks. For example, the startup cost credits would only be available to a business that has non-highly compensated employees, so non-owner employees, which by definition, if you have non-owner employees, you're not eligible to set up a solo 401k. So that's going to eliminate a solo 401k from being eligible for the startup cost credits that were enacted by the Secure Act. But there's another set of credits that were enacted by the Secure Act. They were set up under their own section of the code. They have their own eligibility criteria, and an owner-only business that establishes a 401k plan that includes an auto-enrollment feature is eligible to claim those auto-enrollment tax credits. And those auto-enrollment tax credits are $500 per year for 3 consecutive years. So with the plan offered by MySolo 401k Financial, we automatically draft it to be eligible so that the self-employed person can claim those credits. So all that they need to do is sign up for our plan by the end of the year, and they'll be eligible to start claiming credits of $500 per year for 3 consecutive years. So those credits are tax credits. They're not tax deductions. So in that way, it's more valuable than a tax deduction because it's a dollar for dollar reduction in the individual's tax liability. Now, in order to be eligible, the plan needs to include the auto enrollment feature, other notices. Your basic discount brokerage plans do not include these features, do not include the notices. So those plans are not going to be eligible for the tax credits. But again, we automatically draft it to include all that's needed to be eligible. We provide a deep dive webinar that we hosted with an IRS enrolled agent to all of our new clients that goes through step by step how to complete the 2-page form that needs to be completed to claim the credit so they can share it with their tax advisor. Now, part of that feature will set a default 3% contribution percentage, but the solo 401k owner, as the participant, has the right to opt out of the default 3% contribution percentage. So now they can contribute in whichever amount or schedule they prefer, obviously subject to the limits and the deadlines. It's a tremendous way to help solopreneurs be able to afford to set up a solo 401k. For example, our fees would not even, over the first 7 years, would not even amount to $1,500. So stated differently, these credits will cover our fees for more than the first 7 years. We charge $650, which includes the $525 establishment fee, plus the first $125 annual fee as the initial fee. Then starting 12 months later, we charge our $125 annual fee. It's a totally flat fee. Doesn't go up based on the value of the plan, et cetera, et cetera. All the ongoing compliance support is provided as optional free services as well. So the client knows exactly what they're signing up for. Reason number 3, gain access to a solo 401k loan. So our plan will allow the solopreneur the option to borrow up to 50% of the balance or $50,000, whatever's less, that they could then use for personal purposes, for business purposes. and they'll be able to draw this money. It won't be subject to taxes. It won't be subject to penalties as long as it's documented as a loan, which we handled those loan documentation requirements as an optional free service for our customer. We prepare the documents within 1 business day and then paid back according to the terms. It needs to be paid back in either monthly or quarterly payments up to the client, equal payments of principal and interest. The interest is prime plus 1% or a CD rate plus 2%. It's a fixed rate over a 5-year term. Reason number 4, expert compliance support. So this is all we do, right? Is solo 401k plans and 401k plans for small business. So as the solo 401k plan provider, we're not providing investment advice. We don't hold the money, but we provide the support going forward as an optional free service. So for example, once the value of the plan, including all the different investments, the sub accounts, even the value of any defined benefit plan that the self-employed person might have, exceeds $250,000, there's going to be an informational tax filing requirement that applies, and the penalties for non-compliance have gone up. That was part of some of the changes that were made under the landmark legislation. So now they're up to $250 per day. As you can see, that could really add up very quickly. But we handle that 5500 EZ as an optional free service for our customers. They or their advisors just have to let us know once the value threshold has been met, once the value exceeds $250,000, then we'll add their plan to the queue. We'll follow up with them to gather the information that's needed, and then we'll prepare it so that it can be filed under the electronic filing system to make it easy for all parties. In addition, the Form 1099-R. So a Form 1099-R is needed in different situations. For example, distributions from the plan, conversions. So one of the most popular areas is going to be the Mega Backdoor Roth, because when you make a Mega Backdoor Roth contribution, that's a 2-step process where you first are depositing funds into the after-tax account before they're moved either to a Roth IRA or a Roth Solo 401k. So that second step, that after-tax to Roth transfer, needs to be reported on a Form 1099-R. So we have a form on our website that clients or their advisors will use to provide us the information we need so that we can add their plan to the queue to prepare the 1099-R. So in the context of the end of the year, right, it's unlikely or less likely that someone will have $250,000 before the end of the year unless they're rolling over maybe a large balance. But in the context of a restatement, right, many of our customers start out with the basic plan, maybe at Fidelity or Schwab, and now they want to upgrade it to our plan. So they might have more than $250,000 in assets. So if they restate their plan to our plan here before the end of the year, and then just let us know that the value as of the end of the year, as of December 31st, 2025, is more than $250,000, then we'll add their plan to the queue to handle that 5500 EZ, which would be due by July 31st of 2026. So what happens if you wait? Well, you'll lose the ability to make all types of contributions by the business tax return deadline, including any timely filed extension next year. So if you don't set up a plan until the beginning of, say, 2026, yes, you could still make certain types of contributions, but unless you're a sole prop, you'll lose the ability to make employee contributions, right? If you're an S Corp or a C Corp or a partnership, and you set up a new plan at the beginning of 2026, you won't be able to make 2025 employee contributions. Now, if you're a sole prop, yes, you could still set up a plan in 2026 and still make employee contributions, but you'll have to make those contributions by April 15th. You won't have the option to file an extension. Even if you file an extension, you won't have the option to make employee contributions by October 15th. Whereas if you set up the plan, if you just sign up by December 31st, you'll be able to make all types of contributions, including employee contributions if you're a sole prop, by October 15th if you file a timely extension for your 2025 1040. Delay the first year of the tax credit. So yes, you would still be eligible for the tax credits if you sign up in 2026, but you wouldn't be able to start claiming the credits until you file your 2026 tax return. Delay rollovers, loans, Roth strategies, right? You won't be able to access all the advanced features that our plan offers. delayed tax deferred or tax-free growth, right? If you're not making contributions and investing until next year, then obviously nothing's going to start to grow until next year. Risk non-compliance, right? If you're restating an existing plan and fail to file the 5500 DZ, right? If it's required. So the next steps would be to complete our quick 1-minute application. You make payment, we prepare the plan documents within the same business day. When someone signs up and you've met the deadline, right? You can take your time to open up accounts and fund when ready, even in 2026, as long as you do it by the business tax return deadline, including extension. And we are neutral as far as where the accounts are at. Altruist is one of the most popular places that we're seeing advisors open up accounts. And a lot of that stems from the fact that Altruist makes it so easy, right, relative to some of the other institutions where advisors custody at. Again, we're totally neutral. So we definitely have plenty of clients at Fidelity and Schwab as well. But just as a matter of just sharing our experience, right? Altruist will open up accounts same day. They offer funding same day, for example, via Plaid. Of course, they definitely are compatible with the Mega Backdoor Roth. So advisors can open up multiple sub accounts for their customers' plan that they have through MySolo401k Financial. For example, when you're making those Mega Backdoor Roth contributions, multiple sub accounts are needed because you'll need different sub accounts for each participant. Say there's a husband and wife that are both working in the same business, both participating in the same plan. Each will have their own different sub account, as well as different sub accounts for different types of funds, whether it's pre-tax, Roth, or voluntary after-tax. So the role of Altruist, like any financial institution, is to provide the accounts, and the role of MySolo401k Financial is to provide the plan. The key to understanding, I believe, is that a solo 401k is a legal entity. So like any legal entity, it's the documents that create it. It's technically a trust, legally speaking. So the plan is created by the documents that are obtained through MySolo401k Financial, and the clients are using those documents to open up accounts at the bank or brokerage of choice, including Altruist. So implementation would, of course, include first verifying eligibility. We talked about that as a foundational topic, that they need to be self-employed with no non-owner, non-spouse, full-time W-2 employees. If they want to be able to access these advanced features as well as the tax credits, they need to have a plan like the one offered by MySolo401k Financial that enables all of those features and the tax credits, and then opening up a retirement trust account at Altruist. So, and we'll talk about that here on these next few slides. It's an important detail. Altruist offers their own solo 401k account type. They also offer trust account types. They have now added to accommodate plans like third-party plans like ones offered by MySolo401k Financial, offered it a couple years back, as a matter of fact, but they've now added retirement trust account types. So that's the correct type of account that one would set up if they're bringing their own plan documents to Altruist. Because if you open up the solo 401k account type, really what's going to happen is now you're going to be obtaining the documents from Altruist, where you already have documents provided by MySolo401k Financial. And it's really the documents that create the plan. It's the documents that enable the features. So you want to get the documents from MySolo401k Financial, but then open up the retirement trust account through Altruist. Now this will communicate to Altruist that they're not providing the plan. So they don't need to do tax reporting from a plan perspective, right? That's handled by a third party. So getting deeper into the compliance requirements, you would need to open up separate retirement trust accounts at Altruist. If you're going to have different types of funds, different participants, each account is opened up under the name and EIN number of the plan. As part of the onboarding process, MySolo401k Financial obtains the EIN for the Solo 401k that's specifically for the plan, distinct from the EIN that the individual might have for their self-employed business, that's obtained from the IRS. And then that can be used to open up the different accounts. And as mentioned, these accounts, we're seeing them opened up same day at Altruist, which is definitely kudos to Altruist in terms of just making everything so streamlined for the customer. Funding the retirement trust accounts. From a solo 401k perspective, it's totally acceptable to fund the account in terms of making contributions from a personal account or a business account or even a non-retirement brokerage account, such as a non-retirement brokerage account at Altruist, regardless of the account type. So one can make both employee, employer, or voluntary after-tax contributions from a business account or a personal account. From a solo 401k perspective, both are acceptable. That means you do not have to make contributions through payroll. All types of contributions can be made from personal or business accounts. From a tax reporting perspective, contributions are not reportable by the plan. Instead, the individual needs to work with their tax advisor to report as applicable on the personal or business tax return. Per Altruist, they're not doing any tax reporting from a plan perspective, like a 1099-R or a 5500 EZ for these retirement trust accounts, right? That's the key, so that they understand that the plan is actually being provided by a third party. Now, of course, they may be handling trading reporting, such as a 1099 DIV or a 1099B, and that's where it's important that the account is opened up under the EIN number of the plan, right? So that's the EIN number that is obtained specifically for the solo 401k. So that communicates to the IRS when that is obtained that this EIN number is for a 401k, so that if any income is being reported under that EIN number, such as a 1099 DIV, now the IRS will understand that that income is growing on a tax deferred basis inside of a 401k plan. So the IRS wouldn't be therefore looking for that income to be reported on a personal tax return or a business tax return, like they might if the 1099 DIV, say, was issued under the personal Social Security number or the business tax identification number. Just a final quick comparison before we turn to the questions. Thank you so much for chatting up the questions. So we talked about how it's important to choose the correct account type when opening up accounts at Altruist. So if you go with the solo 401k account type at Altruist, that means it's their plan documents, which are going to be more limited in terms of the features. Whereas if you first obtain the documents from MySolo 401k Financial, it'll have all the features, it'll be eligible for the tax credits, and then you would choose the retirement trust account type when opening up accounts at Altruist. So by going with MySolo 401k Financials plan documents, now you're going to access the advanced features like those listed here, such as the ability to make employer Roth contributions, the ability to make Mega Backdoor Roth contributions, the compliance support that we offer as an optional free service as the plan provider, even the ability to invest in alternative investments like real estate or crypto or notes. Now the ability to claim those $1,500 in solo 401k tax credits that will more than cover our fees for the first 7 years, and even the ability to open up additional accounts if the client was so inclined at other institutions, right? We've helped customers open up accounts at hundreds of different banks, cryptocurrency exchanges, alternative investment platforms, etc. All right, wonderful. Thank you so much for joining today's session. Thank you so much for chatting up the questions. Now let's turn to the questions. Just before we do, if you could please take 1 second to like and subscribe. Liking tells the platform that the content is valuable, which helps other solopreneurs, other interested parties, other advisors like you find it. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Okay, great. So first question from Nicole, can my spouse have W-2 income? Most definitely. So that's a great question. It's a common question. The key to eligibility is reporting earned self-employment income with no non-owner, non-spouse employees. So a solo 401k plan is what they call a one participant plan, right? That's the language in the code. But there are exceptions to that one participant requirement. One exception is a spouse who is also working in the same business. So the presence of a spouse that receives W-2 wages is not going to now transform it to a full-time employer plan. It still qualifies as a one participant plan. You can still open and maintain a solo 401k plan, notwithstanding the fact that your spouse is receiving W-2 wages. And moreover, If your spouse is working in the business, is receiving W-2 wages from the business, now your spouse could participate. It's still one plan, it's still one fee from our perspective. Now, additional contributions could be made, obviously subject to the contribution limits, etc. So there could be tremendous benefits by having your spouse work in the same business and receive their own earned self-employment income. Great question. Thank you so much. Next questions, a couple questions from Jack. Let's read through it. Thanks for bringing the questions, Jack. I have a one-person S corp for my business, an existing client. Wonderful. Thank you so much. My spouse has a W-2 job at a different company, and she's maxed out her 401k contributions there. Now I plan to add her as an employee of my S corp and pay her $40,000 per year. Is it true that my S corp can contribute 40%, or excuse me, 40,000 times 25%, so 10,000 to her pre-tax 401k, and she can contribute another 40,000 to her after-tax 401k for a total of 50,000. The benefit is that she'll have two 401k plans, one from her current company as well as the solo. Also, she could do the Mega Backdoor Roth. That's a great question. It's a common question. So yes and no. So yes, one can participate in the solo 401k, can make contributions to the solo 401k, notwithstanding that they also participate and make contributions to a day job plan. Now, if that day job plan is a 403b, you have to aggregate all contributions. But let's assume here that we're not in that exception situation. Let's assume that the spouse is participating in a day job 401k plan. So let's also assume that they're working in a self-employed business, they're participating in the solo 401k, and as you mentioned, they receive $40,000 of W-2 wages from the self-employed business. So it sounds like they've maxed out their employee contributions to their day job plan, which is very common. That means that they cannot make any more employee contributions to the solo 401k. But there are two other buckets that they could potentially fill, right? You've got three different buckets you could fill up with the solo 401k. Employee, they've already filled it up at the day job plan. The employee contribution limit applies at the employee level. No more employee contributions to the solo 401k. As far as the employer contribution bucket and the after-tax bucket, though, those contribution limits are not reduced by contributions made to a day job 401k plan. They would be if it was a day job 403b, but again, we're assuming it's a day job 401k. So that means that they could make a employer contribution of 25% of their W-2 wages, right? That's $10,000. And then they could do the difference up to 40,000 as an after-tax. So what's wrong with what in your question is that they can't do 10,000 plus another 40,000 because you can't save more than you earn. So the most that they could contribute to the solo 401k would be the lesser of their W-2 wages or the overall limit. Here, their W-2 wages is less than the overall limit. So the most that they can contribute is the W-2 wages. So they could do 10,000 as a pre-tax employer, and then 30,000 as a voluntary after-tax, and then move those over to the Roth solo 401k or Roth IRA. Great questions. Thanks so much for bringing it. Okay, back to Nicole. Do I need to establish a new trust, or can my revocable trust own the solo 401k? So yes, the solo 401k is a trust. Yes, it's a revocable trust, but it's not a living trust. It's not a family trust. It's a federal retirement trust, right? It's a trust because the assets are held in trust for the benefit of the employees, in this case, the self-employed individual. But yes, you can designate your living trust or family trust as the beneficiary of your solo 401k. You would work with your estate planning advisor to do that, to make sure that your specific trust can serve as the beneficiary of a 401k, but conceptually it can be done. That would mean that when you pass away, your solo 401k assets would pass to your living trust or family trust. But your living trust is not owning the solo 401k. You need to have a self-employed business, which doesn't necessarily have to be a formal legal business, right? It could be a sole proprietorship. You don't necessarily need to have an LLC to set up a solo 401k. but you need to report earned self-employment income with no non-owner, non-spouse, and full-time W-2 employees. And then your self-employed business sponsors the solo 401k. It doesn't quote own the 401k, it sponsors the 401k. 401ks are for businesses. A solo 401k is for a self-employed individual. Hopefully that clarifies things. Thank you for bringing that. Good question, though. Next question from Danny. If you have a W-2 403b maxed out and I get a 1099 for $20,000 for this year, and I want to open an account for employer deferral and after tax, if I wanted to put all the contributions, employer deferral and after tax into a brokerage, will that go to the same brokerage account, or do I need to create two different ones? Is there any paperwork I need to file each year? Great set of questions there, Danny. So first of all, when you say you got a 403b maxed out, you might recall in my response to the prior question that while contributions to a day job plan generally do not reduce your ability to make employer and or voluntary after-tax contributions to a solo 401k, an important exception is the 403b exception. Under that 403b exception, all the contributions that are made to the 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall contribution limit, which, for example, for 2025 is 70,000. So when you say you have a 403b maxed out, let's assume you just mean the employee contributions are maxed out and no other contributions were made to the solo 401k. So that means, for example, for 2025, if you're under 50, you would have made $23,500 to your 403b plan. So there is still other capacity to make solo 401k contributions in that scenario, right? Because you could, even notwithstanding that 23,500 was made to the 403b, you could still make another 46,500 to the solo 401k, assuming that you have the self-employment income to justify it. Now here, there's $20,000 of self-employment income, right? You have a 1099 of 20,000. Now you do need to run a pre-calculation when the self-employed business is taxed as a sole proprietorship. Specifically, that pre-calculation provides that you have to take your net self-employment income, i.e. the amount reported on line 31 of Schedule C, less 1/2 of the self-employment tax. And that the product of that pre-calculation is your self-employment compensation. So you would have to reduce that 20,000 by a certain amount, right? 1/2 of self-employment tax. And then of that amount, you could contribute employer contributions and or after-tax contributions. The employer contribution limit is 20% of the self-employment compensation figure. The after-tax contribution limit is 100%, provided that the total amount of contributions, employer and after-tax, doesn't exceed self-employment compensation, right? You can't save more than you earn. So you might put 20% of the self-employment compensation and the difference up to the self-employment compensation amount as an after-tax. 20% is an employer, the rest as an after-tax. So to your questions, those contributions need to be deposited into different accounts. So it would be one plan, one fee, but different accounts, right? One account for pre-tax contributions, another account for after-tax contributions, and then a third account for Roth funds. Because when you make a Mega Backdoor Roth contribution, it's really a two-step process where you first deposit those contributions into an after-tax account, the Roth account. Hopefully we didn't lose audio there. Let me know if we lost audio on that last question. But you would need three accounts, right? After tax, then to Roth. Now, as far as the paperwork that you would need, contributions are not reportable by the plan. They're reportable on the personal tax return or the business tax return as applicable. Now, that means that, for example, you got to report pre-tax contributions. You may have to report Roth if you're talking about a Roth employee and your contribution and your business's taxed as an S Corp or a C Corp, because it needs to be reported on the W-2. Roth employer contributions would also have to be reported, but we generally don't see many Roth employer contributions because most people that want to maximize Roth contributions would just simply choose to make those contributions as Mega Backdoor Roth as opposed to employer Roth. So In your situation, if you're making employer pre-tax and voluntary after-tax, and your business's tax is a sole proprietorship, the only contributions that would have to be reported would be the pre-tax employer, so you can get that income tax reduction benefit. Now, when you make that mega backdoor Roth contribution, yes, the after-tax contribution doesn't have to be reported, but remember, it's a two-step process where you'll then have to move the after-tax funds over to the Roth Solo 401k or Roth IRA. So that subsequent transfer, that conversion, that does need to be reported on a Form 1099-R by the plan. We handle that as an optional free service for our customers. They just have to let us know, or their advisors let us know by submitting the online form on our website to give us the information we need to prepare the 1099-R. And then, of course, once the value exceeds $250,000, clients need to let us know, or their advisors let us know, so we can add their plan to the queue to be able to prepare the 5500 EZ, which we handle that as an optional free service as well. And we do that under the electronic filing system to make it easy for all parties. Okay, wonderful. We'll see if there's any more questions that come through. We want to invite you to our community. We have the largest community of solopreneurs and solo 401k owners, over 30,000 members, which means we've got vibrant community forums. We have a library of videos and webinars, which means there's a ton of ways to learn and to share the knowledge. It is totally free to join. All are welcome. It's not just limited to clients. You can join quickly and easily at mysolo401k.net/my community. So please don't hesitate to join. If I'm a sole proprietor, is the deadline for employer and after-tax contributions December 31st? The deadline to establish the plan is December 31st, meaning sign up. Remember, the key to understanding, in my view, is that a solo 401k is a legal entity. So it's the documents that create it, not the accounts. Also, for self-employed individuals, as long as you establish the plan, meaning you sign up by the end of the year, now you can take your time to open up accounts and make contributions for 2025, all types, employee, employer, and voluntary after-tax by your business tax return deadline, including extension in 2026. When you say value, is that cash or asset value? So it's $250,000. So you have to look at all the assets. So cash, investments, accounts, the total value of those, of the cash, the assets, the investments, the accounts, etc. If it exceeds $250,000, including the value of any defined benefit plan, that has to be factored in if you're trying to determine if the threshold has been met. Once it exceeds $250,000 as of the end of the year, so as of December 31st, that's what triggers the 5500 EZ filing requirement. All right, thanks for those additional questions. It looks like that's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable, and your retirement future is worth it. If you haven't yet, please like and subscribe on whatever platform you're on, LinkedIn, Instagram, YouTube, X, so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Thank you so much, everyone. Take care.